So we're almost. Okay. In just another a minute to go, we'll start soon. Okay. Okay. Rajkumar, can you give the speaker view, please? Wonderful. Thank you. Good morning, good afternoon, good evening, everybody, depending on where you are. A very warm welcome to this G20, annual G20 address of ICRIER. This is the 12th one we are having, and we're delighted to have Professor Raghuram Rajan to give the G20 annual address. We're doing this conference in partnership with IMF, as usual, ADBI, and CAS, and we are delighted to have their support. This is going to be a mouth-watering session by Raghu. Unfortunately, we won't have a dinner after this, as we usually do, so the talk itself will be a mouth-watering talk. It is going to be moderated by Chetan Ghate. Both Raghu and Chetan have had an association with ICRIER proudly, I may say that. Raghu was on our board in the early part of this decade, and Chetan was the RBI chair professor also during the early part of this decade. Chetan will introduce Raghu, but let me briefly introduce Chetan because he won't be able to introduce himself. Thank you, Chetan, for doing this, for agreeing to moderate this session. Chetan is a professor of economics at the Indian Statistical Institute, Delhi, and has been teaching in ISI since 2000. He's a PhD in economics from Claremont Graduate School, a master's from the Delhi School of Economics, and a BA from Colorado College. His research focuses on macro monetary economics, macro development, and Indian macroeconomy. He has published widely in the field. Recent papers have appeared in studies of nonlinear dynamics and econometrics and economic inquiry. In 2014, Chetan was awarded the Mahalanobis Memorial Gold Medal, given to the best research economist in India under the age of 45. He's got several other accomplishments, and let me just say that he has held a variety of visiting positions, and most recently, he was involved with the Reserve Bank of India in an advisory capacity as a member of the Monetary Policy Committee. So thank you, Chetan, for agreeing to moderate this. Thank you, Raghu, once more for giving the G20, 12th G20 address of ICRIER. I hand it over to Chetan.
Thanks very much, Rajat, and thanks for that generous introduction. So welcome to everyone to the annual G20 address on financial stability and responses in times of global uncertainties. I also wanted to thank ICRIER and the entire G20 team who I've known over the years. There are many people involved in this enterprise, and also Issuer, who's no longer with us anymore. But I know how hard they slog in putting this together, and especially this year where circumstances are extremely difficult. So congratulations and thank you once more. Unfortunately, today's conference is happening in the backdrop of a major pandemic and major worldwide recession. The World Bank estimates a roughly $12 trillion loss in GDP worldwide 2021 because of COVID. And that's roughly, another way to look at this is it's roughly a $500 billion gain from accelerating vaccine development by 1 month. The economic harm in countries is projected to be anywhere between 5 to 10% of their GDPs. India so far has seen comparatively fewer deaths, but the economic costs have been huge. And since this is a G20 conference, it's important to remind ourselves that the G20 economies make up roughly 85% of global GDP. And they themselves are seeing a roughly 6.5% dip in their economies in 2020 because of COVID. And of course, they're going to rebound next year because of these base effects. And one of the things that will become important in terms of things to look out are debts. Public debts and EMEs will rise. And that could possibly lead to the outbreak of debt crisis in many EMEs. And it's useful to look back at what happened in World War II. It took 10 years for the United States to reduce its debt to GDP ratio by half after World War II. And this was because of the debt sustainability condition, which economists call R less than G. Of course, G is now plummeted to 0 or to negative, and so this condition doesn't hold anymore. What has been the G20's response? Well, compared to the great financial crisis, it's seen as not working as well. There's a sense that there's a lack of global leadership, and that's led to a lack of coordinated fiscal policy. And because globalization has been in retreat, the commitment to a strong stimulus has been somewhat checkered. But who could be a better person to help us navigate all of this and think about it in a holistic way? So I'm delighted to introduce today's speaker, Professor Raghuram Rajan, who will deliver today's annual G20 address. I just wanted to say a few words about Raghu, even though he needs no introduction to this audience. Many of us know him. Raghu is the Katherine Dusak Miller Distinguished Service Professor of Finance at the University of Chicago at the Booth School of Business. He was also the 23rd governor of the Reserve Bank of India between September 2013 and September 2016. And between 2003 and 6, he was also the chief economist and the director of research at the IMF. Raghu is a world-renowned expert on corporate finance, banking, and development. And while most of us see him in terms of his policy positions, I'd like to remind everyone that as of September 2020, in the most recent REPEC rankings, he was ranked in the top 50 amongst the most cited economists in the world. And this is in a list of about roughly 60,000 registered economists. And in recent work, Raghu has been touching on two recurring themes. One is whether too much financialization can be dangerous. He famously predicted the great financial crisis in 2005 in a Jackson Hole meeting amidst oppositions from some very eminent people. And the second theme that is a recurring theme in his book, In Fault Lines, which won the FT Best Business Book Award, but also the third pillar in 2019, is the theme of globalization and inequality. And I sense he worries about how the pandemic will exacerbate every fault line that had existed earlier. And of course, in his 2019 book, in the third pillar, he argues about the importance of the community, which is the third pillar, or the social side, and says that while the standard view is that strong markets and governments enforce contracts and property rights, these arguments neglect the third pillar, which makes the market and the state work for the many. So with that, let me open the floor to Raghu's address. Raghu?
Thank you very much for having me here. And let me start by expressing my condolences to ICRIER. It has lost Ishwar Ahluwalia, a great economist and a wonderful administrator who has been responsible for a lot of where ICRIER is today. And of course, my condolences both to ICRIER and her family. In today's talk, I want to talk about the pandemic and the issues it raises for EM stability. I will spend more time not on the traditional debt sustainability analysis, which Chetan has talked a little bit about, but a lot more about the corporate sector, which this time around is significantly damaged. This is you don't need me to say this is a crisis like none we've seen before. certainly over the last 100 years. The crisis probably is best described in four phases. There was an initial phase in many countries of trying to contain the virus itself, contain the spread, and while lockdowns were in place, offer relief to households and to firms so that when the lockdowns were over, people could walk out, firms could start up, and the recovery would be strong and as would make up much ground very quickly. So the relief measures that were put in place in many industrial countries were huge and were meant to be a bridge over the chasm of the pandemic. Now, in some countries, the ability to contain the virus has been limited, including most prominently the United States. And therefore, the bridge has had to be extended much longer than what was initially thought. Initially, it was for a few months. And now that initial relief is expiring, and there's a sense that the bridge ends halfway over the chasm. And if it's not extended, the economy has the potential for falling off into the chasm. And of course, President Trump's tweet yesterday saying that talks were off on relief is very worrisome because it is not clear that given the potential uncertainties surrounding the US presidential election, we will get much of a relief package before the new year and the new administration. In the meantime, a number of countries that have contained the virus, most prominently China, is in recovery phase. And China is probably the one large economy which is going to show some growth this year and has come back strongly, not just in manufacturing and exports, which is their traditional strength, but also to a significant extent in services. Now, so the second phase is recovery. We've seen some economies recover, some are in the midst of a tentative recovery, and I'll talk a little bit more about that. The third phase is repair and reallocation. Because many balance sheets are damaged, including the national balance sheet, but most prominently household and corporate balance sheets, there will have to be a period of repair in which debts are renegotiated and the occasional firm is shut down and its assets reallocated. If this phase doesn't occur properly, there is a potential for a long-term hit to the economy's growth potential. And finally, the fourth phase, especially in countries that have been relatively unsuccessful at the first three, is significant reforms to increase growth potential. And let me talk about each of these a little bit more. Success in this kind of situation is to bring down the curve of infection significantly and quickly. The areas that have done this the best, East Asia, especially China, prevented a recurrence and therefore have got economic activity back. Europe has brought down the curve significantly, but now we're seeing second and third waves emerging, which are worrisome because, again, they inhibit activity. We're seeing lockdowns starting to emerge in the UK, in France, in Spain, and we still have the winter to go through when this may get worse. Now, because of the tremendous fall in production in the second quarter of this year, we've seen an equally significant rebound in the third quarter. Now, it is easy sometimes to mistake the strength of this rebound for a full-fledged recovery, partly because it is driven by huge pent-up demand. Remember, we didn't spend much when locked up in homes. And as we come out, we start spending, especially on goods. So manufacturing has come back significantly. And there are also signs of increased CapEx in some cases because firms are buying equipment in order to automate more of their activities. But in many countries, high contact services haven't come back. You don't go to the restaurant as much. Hotels are starved for business except in China. And so as a result, most recoveries are going to be to 90 to 95% of their pre-pandemic growth because 5 to 10% of the economy is not productive. and is unlikely to be productive until we find a full-fledged vaccine or cures become far more effective. Now, the full recovery is also impeded not just by the fact that we're not going to restaurants, but also by the fact that global demand itself has been interrupted and is coming back in phases. Especially damaged are the emerging markets, which I'll come to in just a second. So in countries that have dealt with the virus, the real accent is on preventing second and third waves. Mobility is coming back, the young are clustering together, and of course, they're getting infected. And so long as the infection rate remains contained below 1, you can maintain a relatively low level of infections. The problem, of course, is that rate considerably, and the young are also starting to infect the elderly. Now, thus far, death rates in the second wave have remained relatively low. In part, this is because it's the younger who are getting infected more. In part, it's because, relative to earlier, we're picking up infections much better with increased testing. Of course, we do know how to treat better than we used to. And there are some medicines which we've discovered actually have some benefit. Nevertheless, the point is, if we have a fresh set of lockdowns in these countries that have been successful, it will require significantly more relief again, which will be immensely damaging, both in terms of the lost economic activity, but also the increased debt, the increased spending that will have to take place to support firms and households. So the uncertainty in successful countries is really, can we continue to contain the virus, which depends on the availability of vaccine. Most predictions are we will get something by the end of the year, but full rollout will take another quarter or two. So it's only by summer that many places will feel confident in coming back. That too, if many people actually accept the vaccine. And that too is a question, given how much uncertainty there is about its effectiveness. There are also hopes that new cures come about, monoclonal antibodies. I think President Trump got some of that, could be a potential miracle cure. And that, we're all hopeful, but let us see. And of course, a quick and easy test, which is accurate, would be very effective in helping businesses start up. The big question pending medical advances is how long industrial countries can continue to support. We've seen in the US, the appetite for support has fallen off tremendously. When there was fear of the pandemic in the early days, Congress came together and enacted perhaps the most generous package. But now that the fear has diminished, now politics has come into play. We just saw efforts to continue relief measures has dropped off. What this means is a lot of small firms which are relying on programs like the Paycheck Protection Program will actually now decide to close because they have no support. And households, low-income households in the US were really upfront in consuming because they were getting high incomes from the transfers from the government. Now they will not be able to consume at that level anymore as government support falls off, unemployment insurance comes down. And as a result, we're going to see some kind of a slowdown in consumption behavior. Demand is going to fall off, and that will slow down growth. Of course, the big question that many industries have is how consumer behavior will change. And the longer the pandemic, the more the change that will take place. What we've seen is many of the pre-existing trends pre-pandemic have in fact accelerated. The trend towards automation, the trend towards distance work. Even in my business of academia, the trend towards more distance teaching has accelerated. Now, will this reverse some of the age-old trends? I mean, one of the big questions is about commercial real estate in the US, especially in urban areas. Will the big offices be packed once again, or will office rents plummet, causing big distress in commercial real estate and then in commercial real estate lending? I think at this point, nobody knows. The realistic possibility is businesses will figure out what requires contact and what doesn't. People are unlikely to show up at the office as much as they did in the past, even when the pandemic is over, and they're going to figure out how they will reorient their lives as well as their living arrangements. Last issue that I think is a source of uncertainty is policy uncertainty, not just about domestic policy, but international policy. The China-US trade war has been in a little bit of a limbo. China has not delivered on its commitments to the United States yet that were negotiated early in the year, obviously as a result of the pandemic disruptions. But once a new administration is in place, again, there is going to be some debate. Brexit, as you know, is again up in the air. And there is a serious concern about global trade. In China, there is now a theory of dual circulation, essentially saying that China has to distance itself from dependence on the rest of the world by increasing its own expertise and reducing the demand dependence it has. Of course, if the world separates into two big blocks or three big blocks, this would be a problem, both for productivity as well as growth. And finally, the US presidential election is a big source of uncertainty, not just about the winner, but how long it is going to take to determine that winner and whether that creates problems. Let me, in the next 5 or 6 minutes, turn to emerging markets and describe the differences in their approach from the industrial countries and what implications this has, especially to financial stability. As you know, outside of East Asia, and everything I'm going to say now is outside of East Asia, which has been relatively successful in containing the pandemic, outside of East Asia, many tried the same playbook as industrial countries, but the outcomes have differed considerably. And that's because fewer jobs can be done at home in many of these countries. Some of my colleagues have shown that 45% of work in the United States can be done from home, just like I'm doing right now. But in emerging markets and relatively poorer countries, Bangladesh, for example, it falls down to 10%. Also, households and small businesses have much lower buffers in emerging markets and less of an ability to bear a sustained lockdown, especially because formal safety nets are very, very weak, if existent at all. Social distancing is much more difficult. Basically, people live very, very close together, especially in the slums, but not exclusively there. Much more dependence on public transport rather than private transport, much more possibility of infections there. We've seen in India the consequences of having migrants with no safety nets. When lockdowns are imposed, they travel and take the virus with them, possibly. And of course, EMs start with relatively deficient medical facilities compared to the advanced countries. The one thing that is helpful in these countries is they have younger and less obese populations, which are less susceptible to severe infection and death. Nevertheless, many of these countries have been infected by the fear, even if the death rate seems relatively lower, especially Mexico, Peru, India, very, very badly affected, both in terms of the size of the pandemic, but also the effects on households and firms. So the prolonged battle against the virus has caused much damage, and these countries have opened again, despite high infections. It's hard to fault that because the alternative without any support can be worse. So turning to policy support, what is distinct about this crisis is how much EM central banks have come to the support of governments by cutting rates and sometimes by expanding their balance sheets to buy government debt. Now, is this QE in the traditional Western form? And the answer is no. Effectively, this is monetary financing of the government budget, hopefully for a short time, as governments are placing enormous amounts of debt in the short run. And over the longer run, the central bank reduces its balance sheet. In the short run, effectively what it's doing is intermediating between the banking system and the government to finance the government deficit. Now, how long can this go on? How long can central banks expand balance sheets, especially when inflation is not dead in these countries? And the answer is it can go on so long as inflation doesn't rise. For many countries, a rise in inflation seems far off, but eventually it could happen. And for some countries, it's going to be sooner rather than later, because what the virus has done is damage the supply potential of those economies. And so as demand comes back, even at a reduced level of growth, what you're going to see is higher inflation, and that's going to inhibit central bank financing of the government also. Nevertheless, many governments have been cautious, and some would argue perhaps overly cautious, because they've had lower resources for relief, because of fear of rating downgrades, possible exclusion from borrowing. Many of them haven't spent very much. The IMF estimated in June that EM spent about 5% in terms of credit relief as well as fiscal relief to households, compared to an average of 20% amongst advanced economies. Perhaps the one exception in the emerging markets is Brazil, which has spent a considerable amount in relief. And in fact, Brazil's growth prospects look a lot better than countries that haven't. Now, what is the trade-off here? The trade-off is if you spent on relief, and remember, I keep using the word relief because this is not stimulus. Stimulus is an attempt to increase the demand of the economy. Relief is an attempt to prevent supply-side damage. Of course, they're related, but if you don't provide relief, your small and medium enterprises, your households are much less able to spend when the recovery happens, much less able to produce, and potential growth in the economy is reduced largely from the supply side. So some countries are saying, let's wait till we control the pandemic, because then we can boost demand by essentially doing a whole bunch of stimulus activities and spending. The problem, of course, is if at that time your supply side has shrunk because your small and medium enterprises have gone out of business, that stimulus is extremely inflationary because your potential has gone down. You can't get back to growth. So for a number of countries, the right thing to do, which is what I hear the IMF now saying, is perhaps to spend to diminish the damage than to wait to spend, hoping that they will increase demand. The key question, if you can't spend, if you've determined not to spend for one reason or the other, is that in the recovery phase, you have to repair the damage that has been done. Many small and medium enterprises are sitting on assets, but have high leverage, so they can't borrow more, they can't get working capital to finance their return to production, they can't pay their labor. So these firms do need a restructuring of their balance sheet, a reduction in the debt that's on them so that they can start producing again. Unlike the typical crisis where a firm has a solvency problem because it was badly mismanaged, in this crisis, a firm can have a solvency problem just because activity stopped for 2 months as the lockdown happened. And therefore, to get it back on track may be a good thing. Management is good, it just couldn't sustain the lockdown. And therefore, fixing the problem with these firms, fixing their wrong capital structure, fixing their high debts is essential to preserve the productive capacity of the economy. It's also essential to prevent the bad loan problem from spreading to the financial sector. So in this repair and reallocation phase, and I'll talk a couple more minutes about this and then end, there are a variety of firms that are around. First, there are the large firms, which typically are economically viable, have modest leverage, and have ready access to financing. In India, Reliance would be an example of that. Firms that are economically viable, have low leverage, but limited access to financing, need financing. So you need to make sure the financial sector is able to lend to these kinds of firms. These would be typically small and medium-sized firms that haven't borrowed too much, but need working capital financing as the economy recovers. Credit growth is going to be centrally important for these. Then there are firms that have a viable business model, but have too much financial leverage and are illiquid. And some that have too much financial leverage and are insolvent. The first probably require restructuring of debt. The second may require an equity infusion over and above restructuring. If the markets are open for equity infusion, great. But in some cases, governments may need to provide some equity infusion to start up the process of recovery. And finally, there are firms that are not economically viable with their current business model. A whole variety of restaurants, for example, a whole variety of hotel chains, some airlines, and perhaps they will have to shrink, close down, liquidate some of their assets. All this is important. So the repair and reallocation phase needs credit, massive doses when the recovery happens, possibly targeted infusions of equity by the government, quick and cheap restructuring of debts. You need to have the debt restructuring mechanisms, the courts, the out-of-court restructuring, all of them open. Typically, the bankruptcy courts will get overwhelmed if everybody shows up at the bankruptcy court. So the bankruptcy court has to be a last resort, with much of the restructuring done by banks outside of bankruptcy, only to take the whole out-of-court settlement to bankruptcy for them to stamp it, but not to go through a prolonged bankruptcy process. There will also have to be a number of firms that will have to be closed and the assets liquidated so that they re-enter the economy rather than be locked up for years and decades. Cleaning up the debris created by this crisis is also extremely important. And finally, recapitalization of the financial sector will be needed. Now, what if we don't do that? I mean, what if, like most countries, we bury our head in the sand and hope and pray that it goes away? Well, we have lots of experiences of countries that haven't repaired and reallocated. Essentially, the potential growth of the economy is significantly impaired. There are many unviable firms that continue in business, often with evergreen funding from the banks that basically don't want to see bad loans happen. But these firms are not able to grow, they're not able to price appropriately, and they impair profitability for others. Japan was in such a phase in the 1990s. The European Union, some parts of it was in that phase in the 2010s. What this also does is, for the firms that are viable, it could create underinvestment because they have a huge debt load. Why borrow more? Or why, bankers are also unwilling to lend, and these firms cannot recover because they simply cannot invest in working capital or in capital goods. And of course, if you have all this, you have trapped resources. Unviable firms continuing to operate. One example would be shuttered malls. They can't open up the mall because the promoter doesn't have any money, but nothing else can go in there because no clear bankruptcy has taken place. Now, typically, countries use the same answer. Let's close our eyes and hope it goes away. The problem only grows. Aging does not make this problem better. Unlike good wine, it actually makes it worse. And repeated moratoria and forbearance doesn't diminish the problem. The quality of assets deteriorates. And one mistake many countries make is looking at the stock market to tell them how things are going. Stock market reflects the largest, healthiest firms who may actually benefit from this process, because as the small firms go out of business, they get some of their activity. Really, we have to be concerned that the iceberg under what was visible, the underwater part, is really what is deteriorated significantly. And of course, if this is not arrested, it leads to concerns about the financial sector. A financial sector meltdown would be hugely more costly for these countries, and of course, lead to a spiraling concern about government debt, which I haven't spoken much about. Many of these countries, the banking system holds significant amounts of government debt. So this is a doom spiral, because as the government's health gets questioned, the banking sector's health gets questioned, and it spirals downward even more. Now, let me end by saying, What about advanced countries? Do we have to worry? Typically, emerging markets had to worry about advanced countries tightening and seeing an outflow of capital in a significant way. Well, I think with what the Fed has done, the notion that they would tighten anytime soon is off the table. The Fed has moved towards average inflation targeting. It has said it will seek to minimize shortfalls of employment from its maximum level. It said that it's going to focus on how inclusive the employment is. All this means that it's going to be a long time before the Fed lifts rates, even if it sees inflation pick up a little bit. Of course, if inflation becomes red hot, the Fed will change its mind, but that seems unlikely in the very short run, a year or two. So in some sense, what is more likely is the short rate will be held down. As inflation starts picking up, potentially the yield curve will probably steepen first with the long end rising. Let me end, and happy to take questions. There is a huge amount of uncertainty yet. Still, we are not out of the woods. Despite relatively buoyant stock markets, there's a lot of policy uncertainty, and bad policy can do a lot more damage still. Of course, that is a concern in country after country. In the absence of relief, it is extremely important that we focus on corporate repair. That is central for recovery, especially for the supply side of the economy, but also the demand side. And it's especially important in emerging markets, which haven't been able to provide much relief. If that repair is not done, the problem eventually goes on to the financial sector balance sheets, as banks have to deal with a significantly higher level of bad loans. And that becomes a problem, a significantly higher problem than what we're facing so far. Now, from the G20's perspective, without, with EMs having limited ability to stimulate their own economy, trade would be a very important source of external demand and would lift many countries. And you're already seeing some indications of that. For example, in India, trade numbers look a lot better. And that could be a lifeline, but for that, trade has to remain open. So lots of scope for policy action by the G20. I think Chetan started by saying that there has been limited leadership, but there's always time. There's always a possibility that emerge and the G20 pick up the reins and lead to a better recovery than what we have so far. Let me stop there.
Great, thank you very much, Raghu, for that overall picture. We have one question from Suman Berry, so let me ask that. And Suman says, since this is a conference about the G20, and you were a member of the Eminent Persons Group convened under the German presidency, are there proposals for international monetary reform you believe India should support in its G20 presidency?
Look, I think access to financing going forward is going to be important. And a number of countries aren't in the sort of happy position that India is in terms of its external reserves. Many countries have thin external buffers. And while I said, thus far, the support from the industrial country central banks by keeping monetary competitive has been, there may be a point at which concerns start rising again. I mean, we already see Argentina has some sort of issues with the markets, even after the debt restructuring. And so one of the things that we emphasized in that Eminent Persons Group report was need for various kinds of flexible credit lines, which would allow countries in trouble, but with relatively good policies, to access financing. In this environment where relief is extremely important for small and medium enterprises so as to prevent the economy from essentially going backwards, I think that easy access to financing, especially for a number of Latin American emerging markets, would be extremely useful. I think that the IMF has opened access to the flexible credit line. Colombia just took a significant sort of significant credit line. But one of the things that happened in 2008-9, which hasn't happened this time, is a fresh issuance of SDRs. Now, what this is a mystery to most people, but basically this is easy access to credit for anyone who wants it on a initial basis. And a fresh allocation of SDRs would be a very important enabler for many developing countries, especially in Africa at this point. I understand India has been against this, and I fail to understand why India has been against a fresh issuance of SDRs. It is something that could be very useful in helping relatively poor countries access international financing.
Thanks. Raghu, I just wanted to pick up on one of your ending comments, which trade has to be open. And I was wondering whether vaccine development is happening on different platforms around the world. And one worry is that with US-China trade tensions, and of course the US platform is based on spike proteins. The Chinese platform is different. It's based on something called a live attenuated platform. Do you worry that these kinds of bilateral trade tensions and the lack of cooperation in other realms is going to impinge and slow down the development of vaccines and therefore slow down the coordinated response to the pickup?
Well, as I understand, there's been a fair amount, and I'm not an expert here by any means, there's been a fair amount of cooperation across the world in vaccine development. But of course, this is to some extent now an arms race between the Russians, the Chinese, the Americans, and so to some extent, it would be better if there was a little more coordination, not so much on coordinating research. I think research has to be shared, but more on ensuring that these vaccines are available more widely based on priority, not national priority, but you know, what makes more sense. I mean, for example, getting it to frontline personnel in the medical field should be a priority across the world, so that those who are most exposed don't catch it and have more confidence. But you know, it may not be available in some countries in Africa to the extent it's available to ordinary citizens in some developed countries. So some kind of prioritization of vaccine access would be a good thing. Unfortunately, what we see is really an attempt to corner the market in vaccines by a number of countries. And that, to my mind, is a lack of, reflects a lack of leadership and cooperation.
Okay, there's a question from Neha Kumar. One, why is there dissonance between what expert macroeconomists say about the state of the economy and what investors seem to believe in terms of India's resilience and potential?
Well, I'm not sure which
Could you clarify?
But let me put it more generally. One, the stock market, which is what people are investing in, often reflects the largest companies in the economy. And as I said, what they experience, especially what their valuations are in an environment of relatively low interest rates, reflect what the economy can become going forward rather than the immediate effects of the pandemic. So if they're healthy, they're going to survive, and they're going to also see an increase in demand because small and medium suppliers are out of business. Then you know, they have it. They're in a good place. I mean, think of large private banks in India that are healthy. Yes, they will see some loan losses, but not to the extent perhaps that some other banks may face. Plus, they may get additional business as the smaller guys can't lend in this environment of tight credit. So it is natural that you might see an increase in valuations there. The problem, however, is that what you need to think about is the longer term potential, as well as the kind of inequality, the kind of economic structures that may emerge from this. And the less you do at this point, the more you're going to get a hit to growth potential, and the more the economy is going to get skewed towards the larger players. That is something to keep in mind. Now, for some countries, that's not a big issue. For other countries, it is a huge issue. But as important is the fact that your growth potential is going to be stymied. That's why I'm saying, reforms are a part offset to this, especially strong, important reforms, but they will not completely offset the fact that your supply potential has been significantly damaged. One of the big mistakes people make is looking at what is needed as stimulus, which is really a demand side increase, rather than looking at it as repair or relief, which is really keeping up the supply side.
Right. There are a few more questions here. Rajat, I, for some reason, cannot open my chat box because it's been disabled, so I can't read the questions there.
Okay, so there are some questions in the question and answer box. If you read those out, I will then try and get you the questions from the chat box.
There's another question about industrial supply chains and how the pandemic is affecting, this is by Sunil Sharma, about how the pandemic is affecting industrial supply chains in Asia, particularly vis-a-vis China. And are Asian economies worse affected than, say, other parts of the global supply chain? Other parts of the world that are part of the global supply chain?
Well, I think the trade conflict between the US and China led many people to consider whether their supply chains should necessarily go through China, which many of them did. There are now there is now rethinking that, which is that, yes, maybe we need to reconfigure those supply chains. But at the same time, there is also a recognition that China's done very well in this pandemic. And therefore, offsetting the trade friction is the fact of Chinese management. And so countries are now trying to say, well, if I do take it out of China, where do I put it? Do I want to bring it back to the US, where, of course, we're still dealing with the pandemic? And you may be very far away from the markets you want to serve, especially if Asia is growing very fast. So many companies are, the concerns about excessive concentration of their supply chain is morphing into, let's diversify a little bit, but let's not move away from the market entirely. So this is actually an opportunity for many Asian countries to attract some business. Vietnam has done very well. Bangladesh is doing well. I don't know how well India is doing here, but it is an opportunity to attract some of these supply chains at a time that they are being reconsidered. But I think the notion that they would all leave China, I think, is unlikely.
Raghu, Chetan, you can't see questions on the chat. So Raghu, can I read out? There are lots of questions coming in on the chat.
Sure. Sure.
There's some questions related to what should be the sectors that one could target for the recovery. Will the recovery be green? Can you think of a green stimulus? And what do you expect from the forthcoming G20 summit? These are one set of questions. I'll sort of let you answer these, then I'll get to the other set.
Well, the easiest way to recover is obviously infrastructure, right? And the most far-thinking countries have focused on infrastructure that is going to be alive and well 30 years from now, and that is needed. So, for example, one aspect of infrastructure spending by the Chinese has been on charging stations, so that they can actually enhance electric car use in the future. I mean, clearly, charging stations are a public good in some sense. It could be provided privately also, but the more you have, the more easy it is to buy an electric car. And so that is one place they have gone. But I think broadly, for the governments to think about the infrastructure they need over the next 30 years and to make a huge push on it would be particularly beneficial to countries, because infrastructure, especially hard physical infrastructure, uses so much of what the economy produces, whether it's steel, aluminum, cement, etc. In India, I think the key challenge there is to ease land acquisition in a way that is fair to both the buyer and the seller, so that many of the infrastructure projects which we've got stagnating are revived and help us grow. I think that, to my mind, is the single most important reform that is on the table that could be done in order to promote a revival of the economy. On the G20 leadership, I think it's easy to carve from the outside. So, but I would say that, it's hard to find evidence of leadership of the kind we saw in 2008-9 so far. It may be happening behind doors. Maybe 2008-9, the London summit was well publicized by Mr. Gordon Brown, but it did indicate that there was somebody, looking at these things and in charge. I would hope that, the US presidential election may turn things around and create some support for a global effort in dealing with the pandemic. Right now, I would say that the lack of a global effort is in part because the US has been missing in action.
Thanks. There are a couple more questions I'll put to you, then I'll give it back to Chetan. There are questions that seem to focus on India. Is inflation becoming a concern for India in terms of its refinancing? Is there too much? And the second question is there too much of a focus, not only in India, but elsewhere, on the short term and rather than the long term? And does that focus then take away from what we can do in the future?
On inflation, I don't want to comment too much on the Indian situation, partly because people think I know more than I do. I don't. This is an issue that Chetan may know more, having been on the Monetary Policy Committee till recently, but let me not opine on it. I think on the issue of short term versus long term, unfortunately, the short term is the long term here, because of the enormous damage that is being done by a continued sort of depression in demand. If you don't focus on the short-term relief measures, you reduce growth potential over the long term. This is why in certain parts of Latin America, they're talking about a lost decade already. Many industrial countries are talking about maybe a few quarters of lost growth as they come back. But in Latin America, they're talking about a lost decade. And I think we should start talking in those terms if we are to try and get the action we need. Many sort of investment houses, and maybe this is a response to the earlier question, have a V-shaped recovery. The worse you do this year, you're going to do much better next year. Well, some of that is just pure math. That's, because the base is lower from which you're growing. But it also implies that the growth potential is there. It's only a matter of demand coming back. And I think there are very serious questions about whether the growth potential is in fact there.
Chetan, over to you, back to you.
Yeah, Raghu, there's a lot of discussion, and you've also spoken about this. Feel free to answer pieces of this question as you feel appropriate, about direct monetization and debt write-offs. And of course, indirect monetizations through secondary markets. But I haven't seen anybody really talk about writing off of debt and its implications for inflation because of the fiscal theory of the price level. And I'm wondering if you have a view on that. Second, somewhat related question is, how much larger do you think deficit spending can persist currently in EMEs or even AEs broadly, without generating inflation? or even maybe a depreciation of the currency in the United States or elsewhere? Do you think it depends on global demand, global domestic growth, fiscal policy? What do you think is the limit on direct spending if economists are asking for larger stimuluses? And the third thing is that, do you think EME central banks and even the Fed to some extent, or even the RBI, should be preparing contingency plans more forcefully rather than the RBI is not putting out projections, but should they be focusing on contingency plans more forcefully?
Let me take these. First, there is a magical belief that somehow central banks can finance when the government doesn't have access to financing. What central banks can do is, in the very short run, use their balance sheet to intermediate between banks and the government. So if the government needs to place a lot of government paper in the short run, the central bank can absorb it on its balance sheet. But if you look at the consolidated balance sheet of the central bank and the government, which is what any private player should be doing to see the sustainability of finances, basically anything the central bank does adds to the debt of the consolidated balance sheet. And ultimately that debt has to be repaid. That debt may be in the form of reserve obligations that you have towards the banks. It may be in the form of government paper. Government paper is more stable because it has longer run. Reserve obligations are, very short-term financing. But both are claims effectively on the consolidated balance sheet of the government and the central bank. There is no magic here. And where is this repaid? This is ultimately repaid by the revenues of the government, the tax revenues net of spending, right? So if there is concern that the consolidated balance sheet has grown significantly larger because of emergency spending, etc., there has to be confidence that the government can raise its net revenues to repay that over the long run, right? That is, there has to be confidence that there is government a government desire to bring its balance sheet back into order. And this is why I keep saying, I think this is a mantra from the IMF also, that you can increase fiscal room by making the institutions that convince markets and investors that you will be fiscally responsible over the medium term, make those institutions stronger. So in India's case, it would be, for example, adopt a debt target and put in place legislation which shows that you will move towards the debt target. Appoint that independent fiscal commission, which will look at the budgets and talk about where there is, a lack of transparency, and perhaps you're actually hiding the true fiscal position. If you adopt these institutions, the market will give you more room. So again, the central bank is a stopgap arrangement. What really matters is the quality of your finances. If you build more credibility of those finances over the medium term, you have more space to spend today. You have more space to spend today, you will provide more relevant targeted relief, which will expand your growth potential over the medium term, make those debts more easily sustainable. This is a good virtuous cycle, requires significant action in the short term. Bad cycle is to say, I won't spend because I don't have the money, rating agencies may downgrade me, we'll pick up the pieces when we find them, and the private sector deteriorates and growth potential falls, and the rating agencies eventually decide that, you have huge debts, you're not growing, and let me downgrade you anyway. And you go into the vicious cycle. That's the alternative. And if the government is frozen and does nothing, that's the alternative, you go down. This is true for many emerging markets. It's something that they should look at carefully.
Okay. There's a quick question here, short question. How do you see the impact of cross-border digital trade, particularly in India?
It's interesting. I mean, I don't know what forms it will take, but clearly it's an area where India has some expertise, and it would be important to expand it. Now, I can see digital helping real trade, right? If you're a carpet maker in Kashmir and you want to access an international market, perhaps some of our internet platforms, especially those that have access to international networks, can facilitate that carpet makers' exports by essentially allowing them to show those goods internationally and providing the logistics to lift the carpet from Srinagar and transport it elsewhere. So, I think those are possibilities that exist. I also think there are pure internet possibilities. We have a gaming industry that I just discovered, and perhaps we can start producing games that the rest of the world is interested in. And there's a huge emerging industry in terms of revenues from that. So by all means, I think we should expand this. We should support it, and maybe we do have digital trade.
Chetan, there are a couple of questions here. Raghu, do you have time? A few questions.
Sure.
Yeah,
Sure.
there are a few questions coming in around. I think you've answered the question. There's a question on fiscal space and fiscal balance. Should we worry about fiscal deficit now or not? There's a question on Atmanirbhar Bharat, and is that the right way? And is this an opportunity for India to energize the bond market, especially for green infrastructure? Should we use the crisis as an opportunity to do that? And finally, how should India and the rest of the world deal with China? In a multilateral or bilateral sense, how should we deal with that? So these are a few questions coming in on.
Okay, let me quickly tackle both, respecting the time that you have for this. One, I can't tell what Atmanirbhar Bharat means, in the sense that we had Make in India, and I thought that meant, I would like to have thought that meant expanding the capacity to have a whole variety of sources of production in India by creating an enabling infrastructure, creating an enabling sort of regulatory space so that people would come in and invest. And amongst the things we need to do is obviously ease of access to various forms of infrastructure, including logistics, as well as enhance the ease of land acquisition, et cetera, et cetera. Now, if you did that, you could make in India, but you could produce for India, you could produce for the world. Different companies will choose that. But what was important there was not to recreate the license permit Raj or recreate a protectionist environment. And when we talk about Atmanirbhar Bharat, I'm not quite sure which side is being emphasized. If it is the let's create an environment for production, I think that makes a lot of sense. And it basically reiterates what Make in India, it's repositioning or rebranding Make in India. If it is about protectionism, and unfortunately India has erected a lot more tariffs in the last few this thing, it doesn't make any sense to my mind to go that way, because we've tried that before. We had the protectionist Raj earlier, and that protectionism was problematic. It enriched a few of our corporations, but basically was a source of poverty for many of our citizens. What we need to do is have world-class manufacturing, and that means our manufacturers have access to cheap inputs also, because cheap inputs are the basis for strong exports. So by all means, we need to create the infrastructural support, the logistic support, etc., that being part of global supply chains would require. But let's not create a tariff wall because we know that doesn't work. I mean, many countries have tried it, and we should ask our friends in Latin America for how effective that is, and they will have the same story that we ourselves have known. I would also say that we need to work very hard on our educational sector, because that's going to be, and to the earlier point, that's going to be the source of service exports. I mean, now we can actually trade across borders. We can provide education across borders. Can we build our education sector so that not only do we have strong outputs that go into industry, but the education sector itself becomes a source of exports. I mean, those are examples of what we can do. And if that's what Atmanirbhar Bharat is about, I'm all for it. But if it is about protectionism, once again, I don't think it's going to be successful.
Chetan, back to you.
On the last point on China, I would say that, you know, it is interesting that China has become quite aggressive after recovering from the virus on a number of fronts, including on issues relative to Taiwan, relative to the South China Sea, and of course, the border with India. I don't know what is driving this. I'm not an expert in geopolitics, but I do know that in the longer run, the world is best served by having a China that is part of it, but also respects its international obligations. And to my mind, the dialogue we have to have is between democracies and China, essentially persuading China that its path lies not in antagonism and in conflict, but in responsible integration. And again, I think that needs the US to be part of that dialogue rather than engaged in a bilateral bilateral fight. I think creating that coalition of democracies may be the way down the line for a engaged dialogue. Multilateral is always better than bilateral, and that tends to diffuse the direct tensions, but may result in greater sort of activity in the right direction. That is, China becomes a responsible global citizen.
Thank you, Raghu. I think by answering the Atmanirbhar question, you've answered a number of other questions also on SMEs and their efficiency, etc. So I won't read those out to you. Over to you, back to you, Chetan.
Thanks. I realize we're impinging on time here. It's already 7:36, so I'll ask maybe one question more. Rajat, is that?
Yes,
okay.
Absolutely. There is so much interest in this talk. It's incredible. Thank you.
So this is, question is, do we require a different institutional mechanism to oversee the restructuring phase for industrial firms in countries like India?
We may. I think each country has to figure out for itself whether the existing structures are right. You don't want a proliferation of structures because then there's a question of where you go. But if you have structures that work, I would say they have to be working full-time now. And if they're not working full-time, one, they should be working full-time, and two, you have to think of how you can expand them, because the size of the distress that needs to be dealt with is going to be substantial over the next few years. So I really think countries should look. And to some extent, they should also see if those structures are the right ones for the problems created by the pandemic. As I said before, typically you reach distress when you've mismanaged. In the pandemic, you may reach distress either because you started with the wrong capital structure or because your business was locked down for 4 months and you had no option. But you may be a viable, good business, and to let you go out of business may be a bad thing at this point. So we need to readjust our thinking. The earlier thinking was, if you're in distress, you're bad, let me take you out, let me get rid of the promoter, let me change management. You may have to rethink that for the pandemic.
Well, Raghu, thank you very much. We've run out of time, and I won't spend time on summarizing all the interesting points that have been made. But to thank you once again for your time, and Rajat, over to you. Thanks very much for a very interesting Q&A and discussion and talk.
Yes, yeah, I completely echo Chetan. Thank you so much, Raghu. And there's so much interest, judging by the number of questions that are still coming in the chat box. Unfortunately, Chetan didn't have access to them, but there's still questions coming in. What we will do is that we will put this up on YouTube with your permission, and I'm sure people would love to hear this at their leisure. I'm sorry to those who we haven't been able to answer the questions, those who've asked questions and Raghu hasn't been able to answer. But thank you for engaging. Thank you for a wonderful G20 address, Raghu, and thank you, Chetan, for skillfully moderating this session.
Thank you very much.
Have a good day and good night wherever you are. Thank you.
Bye.
Bye.